Then my few ideas on how to prepare yourself for a crash. Should there be one, but it's beginning to look more and more likely because things can't go on. Things, what was that saying? Things that you think can go on forever just cannot. I'm paraphrasing really badly. Anyway, this is a great quote from a great book that I can't recommend more than enough. It's called The Psychology of Money by Morgan Housel. It's a short read. It's basically a summary of a lot of his blog posts that he wrote. But he said that bubbles do their damage when long-term investors playing one game start taking their cues from short-term traders playing another. Basically, he says that, say, for example, you're a value investor buying undervalued companies and values underperformed so long that you get completely fed up and you start buying companies like Tesla and other high-flying tech stocks. Obviously, traders know what they're doing. They're buying this company on a momentum play, in and out daily. But the long-term investor, first of all, doesn't watch the stock that closely. So he's moving into a completely different game that he doesn't know exactly what to do and he's got no experience from, which probably means he's going to lose a lot of money. Just think about all the value investor guys that started buying internet stocks at the top of the tech bubble just because value was underperforming so badly. And I wonder how much of that is happening at the moment with value fund managers throwing in the towel saying, we've lost so many assets under management, we've got to start buying some tech stocks. And here's another piece of something out of his book. He said, few things matter more with money than understanding your own time horizon and not being persuaded by the actions and behaviors of people playing different games than you are. Think about the trader and the value investor again. The main thing I can recommend is going out of your way to identify what game you're playing. Just be sure as to what kind of investor. I know I'm a value type investor. I like momentum to avoid value traps, but my basic investment strategy is buying undervalued companies, holding them until they become fairly valued or even overvalued, and then moving on to the next undervalued company. And that's why I'm not trading Tesla. I'm not getting interested at Microsoft at a PE of 35. And here are a few other points on how to prepare yourself for a crash. Avoid a permanent loss of capital. I mentioned Microsoft just before with a PE of 35. If you buy Microsoft at a PE of 35 and there is a market crash, and after the market crash, the market comes back to normal and the people start thinking that a normal company growing at a nice attractive rate should have a PE of about 18. If Microsoft goes from a 35 PE to an 18 PE, that's permanent loss of capital. But think about some of the companies invested in it or rather recommended in the newsletter. They have a PE of between 8 and 12. If there's a crash, of course, they'll be pulled down from a 12 PE maybe to an 8, or an 8 will go to a 6. But once the market comes to its senses over time, they'll see that this 12 or an 8 PE was really a good maybe even undervalued or a fair price for this company. And the company will trade at 8 or 12 times earnings again, which means there's no permanent loss of capital. I can't remember exactly. There was a quote, if you bought Microsoft at the top of the internet bubble, it took something like 20 years for the stock price to get back to that level. Obviously at a much lower PE, but the company grew substantially over that period. Obviously you want to avoid over leveraged junk. And now you can think of Sparks, you can think of, I don't want to say Tesla, but these overvalued companies. And think about all these internet type companies with absolutely no profits, with monster valuations like Uber and things like that. Those are the kind of companies you want to avoid. If you want to trade them, fair enough, but don't bet the house on those companies. And don't get sucked into what's working now. Do not become a trader if you're a long-term investor. We talked about that in the previous quote from Morgan Housel. Have a plan to implement as the markets fall. And this is something where I lost out in the Corona crash as well as the financial crisis. When the markets lost 20% or 30%, I thought they were going to lose another 20 or another 30%. This largely kept me out of the market until a lot later. And now I've got a bit more of a plan saying that if markets are down 20%, then I'll start investing 10% of that cash percentage that I have. And then if they go down to 30, then I'll buy another 10%. And I know that it's going to be difficult for me because I always have this tendency to think that the markets will fall further even after they've fallen 20 or 30%. But I've got a plan now, and I'm going to see if that maybe helps for me. Think about something in terms of what you want to do with your portfolio, how you want to start investing if markets fall. Because remember, when there's a big crash, markets always overreact, and it's usually the best time to invest because you get companies that are really so cheap, good quality companies as well. And have a plan on how you will manage the pain. I have a friend, we came through 2 crashes already, and there's that great finding by Daniel Kahneman, wrote it about in his book Thinking Fast and Slow, where the pleasure you get from a gain in the stock market is only 1/5 as much as the pain you feel from a loss. And that is really true. I mean, think about how many friends sold out of the market at the bottom at a crash, if you can remember that, just because they were so tired and how can you say, exhausted from looking at that negative number on their brokerage statement all the time. Have somebody that you can talk to that understands these things, that can help you. I mean, you can talk to him, and he can talk to you to keep you in the game, because that's probably the main thing that you want to try and do.